Welcome to another episode of Hospo Health. My name is Charles Badenack. I'm a financial advisor at Main Street Financial Solutions in Hobart, and I'm joined by my Gen Y colleague, Michael J. Fox. Thanks for joining me, Michael.
No worries, anytime.
Now, today we're going to be talking about insurance, more particularly personal insurance. So, for most of us, it's a necessary evil. So, personal insurance is the type of cover that will provide a financial assistance in the event that you can't work, you become ill, you become temporarily or permanently disabled, or unfortunately you pass away. So it's actually designed to actually provide a lump sum to give you financial peace of mind for you or alternatively your loved ones. So as a young homeowner, Michael, with the usual commitments, it might probably be best if you actually explain what the main types of insurance are to us.
Yeah, sure. So as you briefly touched on, some of the events that would pay out, or we would call it insured event. There's four main types of cover, which is life if you pass away, so the definition there is pretty straightforward. There's total and permanent disablement, which is pays a benefit if you're severely disabled and can't work again.
And with that total and permanent disablement, that actually you've got to, normally it's 6 months, isn't it? You can't work for it's a 6 month waiting period, and then you need two independent medical practitioners say that you can't work again. That's how it works, isn't it?
Yep, there is, and there's also the occupation definition that you need to be conscious of. So there's the own and any, which is if you're highly qualified, if you've gone to uni as such, it's important to have own occupation. So you can't work in your own job. Like we use the common analogy of like a surgeon might be able to work in as a parking meter attendant. So then he couldn't claim on any occupation cover because he could work in some job, whereas he obviously couldn't work as a surgeon, so he'd claim on the own occupation component.
I also think that total and permanent disablement, one of the things that we've unfortunately come across a couple of times is where someone's got a limited life expectancy, so whether it's through cancer or something, you can actually normally claim your TPD if you have life expectancy of under
generally
12 months. Isn't it? Yeah,
yep.
So, and I suppose you've the big one, income protection insurance, Michael.
Yeah, that's generally the most important one for particularly young people, because when you look at where you are now and where you want to get to, generally your income's your biggest asset in terms of achieving your financial goals and objectives. So it's really important that you do protect that.
So if we extrapolate that for someone who's 30, for example, if you're 30 and you're earning $100,000 a year and you miss out on 30 years work, that's like $3 million. So that's pretty significant, isn't it? So
it is.
And we've also got trauma cover as well. So trauma pays out a specific payment if it's normally sort of stroke, cancer,
heart
there's
attack.
a list of things. So that's and that's the one you're most likely to get, really, isn't it?
Yeah, it is. There's some worrying statistics that are around, like 1 in 3 to 4 people will claim on it over the life of their policy. So those issues are quite common. I suppose that's what we see. The nasty side of it, through our office with, how many claims actually happen. Because
I suppose one of the things we've actually sort of seen over the years is that you and I can have an insurance policy, but you might pay $500 a year for your insurance policy. I might pay $3,000 for my insurance policy, but your $500, the definition is really quite narrow. It's quite specific, so it's harder for you to claim than it is for me. So it's like anything, you pay for what you get. So it's important that you have a comprehensive policy. So, for example, we've had a couple of people with income protection, haven't we, that have benefited from that?
Yeah. So there's someone we had a year or so ago that fell over and broke a wrist and actually got a large $10,000 one-off payment straight up.
And that was in addition to his income protection.
Yeah, it was. Whereas if you had a cheap no frills policy, kind of inside an industry super fund as such, you generally wouldn't be getting any of those payments. And also it adds a layer of complexity because then you have to be able to actually get made a condition of release to get money out of super. So whereas if you own the policy personally, that pays the benefit straight to you, but also the premiums, like what you pay for cover, is tax deductible. So it really lowers the cost of cover to you. Yeah,
because I think for me, with my income protection, I think the net cost is about $3 a day. It's actually quite cheap. It's like half a meat pie, Michael, for protect myself. It works quite well. So there are a number of factors that impact in terms of the cost of insurance, which is really important. So the older you get, the more expensive it becomes. So life insurance for me would be a little bit more expensive than you, Michael. Not much, but a little bit more. And then it has at some point in time, unless you're careful, particularly where you've got a step policy, it can increase at sort of 10, 15, 20% a year. So let's say you do a direct debit every year. you don't even notice it. So you can find in a situation over a 5 or 7 year period, your premiums could have doubled. And that has a very significant impact on people's cash flow, doesn't it?
Yeah, it does. You just got to make sure as well that the cover you have in place is reflective of your situation. So, over time, as your situation can change, as Charles mentioned before, like children, mortgages, that sort of thing, you actually find that the older they get, you can start to drop your cover because, your children start to become financially independent, the mortgage starts to, become repaid, and also, your super portfolios build. To avoid the cost really shooting through the roof.
So you really need to review it every year, don't you? Because otherwise it's like the silent killer of your wealth.
It is.
Insurance costs, isn't it? Really?
Yep.
So, because you have a number of other factors which impact what it costs. So it's the amount of cover, for example. So if you insure for $1 million of death cover, it's more expensive than insuring for $500,000, for example. Or there are a whole lot of levers which you can actually pull with your insurance to make it affordable, because it is about balancing cost and cover. So if you look at your income protection, for example, one of the things we often do is someone might have a 60-day waiting period versus a 7-day wait period, for example, and that has a very significant impact on the cost. And then we can push it out to 3 months. Or if instead of paying through your benefit through to sort of 65, you might pay it out for 5 years when you're 50, because that might be enough to get to your financial end goal. So I suppose it's really important to get advice on that, isn't it? Because it can be pretty traumatic, and we've seen instances where people have had insurance and the benefit it's provided for them, haven't we?
Yep. And on the other side as well, if you're not protected, and then a nasty event happens, then you could be forced to sell assets, sell your home, or not be able to provide the financial lifestyle that you'd like to for those around you. Your dependents.
But I suppose one of the other factors that impacts your premium is your health. So if, for example, you've got a pre-existing condition, you might have an exclusion or a loading for that. If your body mass index is higher than what's prescribed, you may have a loading for that. So that's really important as well. And what some people will say is they say, look, I'm not going to disclose it. Well, that's kind of the worst thing you can do, really, because if you don't disclose it with the authorities, they have, Michael, they can actually access Medicare and all those things, can't they?
Yep. And then you can, at claim time, they can actually go through your medical and Medicare records and find, if they find something that you didn't disclose, you could potentially have your claim denied, which then means you've also been paying premiums for all these years for cover that you can't even use.
Yeah, and I suppose the other big factor in terms of cost, and particularly where you're accumulating wealth during the sort of, so the period up to sort of 45, is that you generally would have most of the insurance coming out of your super, because it helps with your day-to-day cash flow, doesn't it? Like the only one the two I paid out of were trauma and income protection, the rest came out of super. You're probably similar, are you?
Yeah, I have the same arrangement.
Now, Michael, not that you participate in this activity, but smoking, how does that impact insurance?
It effectively doubles the premium, obviously, because smokers are generally at a high risk of, I suppose having a lot of conditions, happen to them, or whether it's lung cancer or those sorts of things.
And do you want to perhaps there was that instance about sort of 18 months ago, where that client had that one blemish. Do you want to talk about that impact that expensive cigarette cost him?
Yeah, so there's a person a client who had one cigarette and disclosed it, then. Well, I suppose it's a good thing that they actually said, I don't like smoking, it doesn't float my boat at all. That was it. But because they disclosed it to the insurer, it effectively doubled the cost of his cover, and it's 12 months before he can actually apply to have that removed.
And I think that was a nightclub cigarette too, wasn't it, Michael? It was like it was just a random.
It was.
And this is because of the danger where you actually, if you don't pay attention when you answer the questions on a risk profile or risk insurance questionnaire, isn't it?
Yep.
And I suppose the other sort of hidden danger with all this is rolling over super and insurance. Do you want to just touch on that point for a moment?
Yeah, so obviously if you have insurances attached to your super portfolio and you roll it from one fund to another, and it'll close your old account, and if you have insurances within there, when you close that account you effectively lose the cover. And then the trouble is if we want to reapply for cover, the older we get, the harder it becomes, because then underwriters start to look at your medical history, and all those sorts of things. So, and also you can potentially be in a situation where you don't have cover at the time you need it the most, or if you go to have a claim and then it's not there. That's really the main concern.
And what about DNA testing, genetic testing? How does that work with? Because that's a bit of a minefield, I suppose, with insurers at the moment, isn't it? Yeah,
it's a relatively new field. Obviously, there's benefits personally at doing it and getting a bit of an insight if there's any familial history or hereditary conditions and that sort of thing, so you can kind of get on the front foot. Then the issue with the personal insurance landscape is insurers will ask you and say, have you done genetic testing? And then you're required, if you apply for cover over certain limits, you're actually required to disclose the results of your testing to them, which can then lead to adverse outcomes from an insurance perspective.
And so really with personal insurance, it's really about balancing cost and cover. And that's an evolving journey for you. So when you first start out in the workforce, you probably need a minimal level of cover, but if you get married and have children and have a mortgage and all that sort of stuff, then you need to increase your level of cover. Then over time, as your asset base increases, you tend to sort of self-insure. So you tend to actually reduce your level of insurance because your asset base has increased. And so as you start to get in your sort of from probably 45 onwards, insurance can be a very costly thing to have. So you would generally reduce your level of cover. So whether that with your income protection, for example, whether that's reducing the cover from sort of $150,000 a year down to sort of $100,000 a year, or extending the waiting period, or limiting the benefit period. So instead of paying through to 65, pay it for 5 years, or things like that. So it's actually about sort of working out what works for you, but there are some levers which you can use. But unfortunately, insurance is a necessary evil, isn't it, really? And if it's a great peace of mind thing to have, but can be expensive unless you review it regularly. Well, some really good tips there, Michael. Thank you very much for your time, and thanks, ladies and gentlemen, for watching.